Okay, hi everyone. Thanks for joining us today. Today's online interview session, whatever you want to call it, webinar, is all about tax planning for digital agencies. So for those of you who don't know me, my name's Paul Barnes and I'm the Managing Director of MAP, and we provide a full finance function for digital agencies. But we're not here to talk about MAP today, we're here to talk about tax planning. So whether you work with us or any other accountancy firm, you're going to get some real value from today in terms of understanding what tax planning opportunities might be available to your business and to yourself as an owner of a business as well. The tax legislation is hugely complex. We can't always blame accountants for missing things, and that's why we brought Adam and Adam in today to talk about how their businesses help accountants and help you to identify some of the tax planning opportunities that are going to be available to you now and proactively available to you in the future as well. So we've made it easy today by inviting two people called Adam. That was part of the remit. Do you want to just introduce yourself, guys?
Sure, yeah. So I'm Adam from Diagnostax. We provide tax diagnostic software, which is designed to help identify tax saving opportunities for owner-managed businesses like digital agencies.
Yeah.
And we're here today with MAP because MAP are a forward-thinking firm who are leveraging the best in modern technologies to provide service to their clients.
Yeah, brilliant. And it's important just to acknowledge as well, I think that a lot of what we talk about today will apply to most types of businesses.
Absolutely.
We're making this 100% relevant to agencies, but a lot of it can be applied to different types of businesses. Adam?
Great, I'm Adam from Forest Brown. I'm a director at Forest Brown, and we help companies with their R&D claims. So R&D is a really valuable government incentive, helps support businesses on their growth journey. So we're here to explain a bit about how that works. It'll link into how we're looking at things from a tax point of view. We explore that angle as well later on. And we've worked with hundreds of businesses in the digital and creative space. And so there's a real tie-in with the work that MAP does there.
Yeah, brilliant. And I guess a lot of people that are coming on this may be wondering why they've signed up to a webinar about tax planning. I get that not all agency owners are waking up like us geeks excited about saving tax, but I believe they should be. The reason that I'm passionate about it is because you work so hard to win work, to market your business, to deliver projects, and actually tax planning is up there with one of the most seamless ways of putting cash on your bottom line compared to everything that goes with running projects.
People spend a lot of time raising money as well,
yeah.
Whether that's through the projects they do or external sources of fundraising, and being able to actually save some money that's already there in the business and recover some money is a really valuable source of generating cash.
Yeah, and I think it's really important to note that there are tax reliefs within the UK legislation that exist for this purpose, and oftentimes they're underclaimed by owner-managed businesses.
Yeah.
That's a shame.
Yeah.
It's really it's just about using the rules in really the way that they're intended to be used.
And just to be clear, we're not talking today about tax avoidance schemes, high risk schemes. We're talking about tax planning that is designed and encouraged by HMRC.
Yeah, and promoted by
Absolutely
HMRC as well. Yeah.
Brilliant. So we're going to start with yourself, Adam, on Diagnostax. We spoke before about kind of the journey that agencies go through, and we thought we could address some of the tax plan opportunities that are available, different parts of the journey. So startups, there'll be some agencies, some tech businesses that are listening today, and they're still in the fundraising phase, they're still in the startup phase. What sort of things should they be thinking about when it comes to tax planning?
Yeah, absolutely. So I think Adam mentioned, tax planning and tax reliefs are one of those great ways to help ensure that there's more cash in the business that you can reinvest into to grow the business. And I think when a company's first starting up, then oftentimes one of the things that you want to look at is funding. So there are a lot of reliefs that exist for investors, most famous of which are EIS or SEIS.
Yeah.
Now, these are reliefs that are designed to ensure that external investors can invest into the company and reclaim very valuable tax reliefs.
Yeah.
So for EIS, it's a 30% income tax relief. So 30% of the amount invested can actually be deducted against the income tax bill of the investor. And for SEIS, it's 50%.
Yeah.
So if you think about it, for every £100 of shares that an external investor would acquire, from an SEIS perspective, they've only really spent £50. Now that's hugely powerful in helping attract external investment.
And when does it flick from SEIS to EIS again? Just talk us through that brief.
So that's to do with the size of the company. There are a number of different requirements to do with the turnover, the number of employees, a variety of different
How
things.
long have been in business?
Precisely. So for SEIS, it really is the very smallest of the companies. EIS is a little bit more forgiving, I suppose, from the size.
But there are, like you say, there are investors who are proactively looking to make these type of investments because they've got a big tax bill.
Absolutely.
So it massively reduces the risk for them. A lot of the risk is taken off the table with these reliefs, isn't it?
Completely, yeah. And, the initial income tax relief, that's just one aspect of it. There's also capital gains tax advantages. Because if the company does do well, you come to sell those shares in the right circumstances, those shares will be, the disposal will be completely free from tax. Hugely advantageous.
And whilst this is relief for the investor, which might not be the agency owner, the person watching this,
the end result is more money in the business for them. Yeah, of course.
Just to add, with the EIS and SEIS companies who we're talking to about R&D claims are always asking us, I've raised money under SEIS or I've raised money under EIS, can I qualify for R&D tax credits as well? So the answer is yes. There's a few quirks it's worth having a conversation about. But don't eliminate the opportunity for R&D simply because you've raised money under SEIS or EIS.
That's kind of the mate in the pub rule, isn't it? My mate in the pub told me I can't claim. Just get some professional advice because you might just be able to. Brilliant. So you come out of startup, you start to grow. One of the things you want to do is invest in your best people. So your key people, your management team, you want to start investing in them so that you can start to become more of an owner than a manager of the business. What sort of tax relief should you think about then?
Absolutely. So when companies start to enter into the growth phase, as you mentioned, retaining those and attracting those key employees, really vital. And there are a number of different ways to do this. There are so many different opportunities. One of the most common routes and most advantageous would be share schemes. So, for example, EMI or CSOP, we call them. These are simply ways to grant employees the right to acquire equity in a company in a tax advantageous way. So if you just grant an employee shares, then they'll be taxed on them. But if you grant them a tax efficient option, that means that they can benefit from the growth in the company without really many downsides for the business owner. So you don't have to grant equity straight away. They benefit from the uplift in value. It's kind of a win-win scenario.
And it's also an alternative to paying cash out. So rather than pay rises or bonuses, you can save cash in the business by giving equity, if that's right. Obviously, there's commercial decisions to be made there as well. But
there are commercial decisions to be made. But it's interesting that a lot of the concerns that people have from a commercial perspective, they don't want to dilute their ownership. Maybe they don't want to, dilute control. Oftentimes these can be managed through simply drafting through speaking to advisor and getting professional advice. If you've got an issue with control, then you can have options that are exercisable only when they sell the company. What does that mean? It means that they don't actually have ownership. Your employees don't have ownership up until the point at which they sell the company. They still benefit from the uplift, but there is no risk from a dilution of control.
And if they leave in the meantime, leavers' rights and things like that.
So, exactly right. So there's all sorts of routes and opportunities there for tax savings. Now, granting share options is not for everyone. Obviously there's a lot of conversations to be had there. It can be tricky, but there's loads of other, ways to help keep employees, classic tax efficient benefits. There are so many options there, ways to tax efficiently remunerate employees. Or another good example where you do have companies that are cash rich. You can, for example, you could make a loan to employees. Not often something that's really well known is you can actually provide employees with a loan of £10,000 completely tax free. No interest. Give them that loan. Only really works where it's a cash rich company. But if you can do that, then it's advantageous to the employee, but it also ties them down because leaving effectively they have to repay that loan when they want to leave. So it's another quite simple way to help keep a hold of those key employees and benefit them efficiently.
And and they're likely to look favourably on their employer if they're giving them £10,000 worth of cash to put a deposit on a house. Or,
Totally.
Yeah.
Win-win scenario.
Okay. A lot of agencies are kind of stuck in that decision as to whether to scale a service business or to invest in product. There are reliefs available, aren't there, that can help just to make that decision a bit more informed and a bit more attractive in terms of investing in tech. Do you want to talk us through some of that?
Absolutely. So when it comes to investing in new technologies, then that is an area that the government is really keen to incentivize. And that's, of course, something that I was going to talk about with R&D tax credits, really valuable relief. Definitely want to consider. Another area, once you've developed that technology, if you can patent it, there's a relief called Patent Box. And what that means is that the profits that derive from that patented technology are taxed at only 10%. What that means is, in effect, you can basically halve your corporation tax bill just by ensuring that you meet the right requirements.
Mm-hmm.
Now, oftentimes people actually have developed technology that can be patented and they just won't realize it. So it is oftentimes when you have developed innovative technologies, really worthwhile having that conversation with your advisor, because it's not just useful from protecting the IP, it's also useful from a tax saving perspective as well.
Brilliant. And like you say, that the whole point of diagnostics might exist is because there are so many questions, aren't there, when you're making these decisions, and the point is to work out what it is you're trying to do as a business, what IP you're looking to build, when you're looking to exit, and all those things affect what you should be looking at from tax plan opportunity now or in the future.
Absolutely right. So thing about taxes, you can't just expect, on day one to meet an advisor and they can just identify every possible tax saving opportunity that will ever be relevant to you during the business cycle. It's really important to be able to meet with those advisors and consider all the different, tax saving opportunities that are relevant to you at that time. And that's the reason why, it's important to meet with advisors regularly. But also, given the breadth and the complexity of legislation, as you mentioned earlier, Paul, it's over 18,000 pages UK tax legislation. Within that, there's over 1,000 different tax reliefs and allowances, many of them underclaimed. And that's why harnessing technology like Diagnostax allows us to make sure that we're able to identify all the reliefs that are relevant for clients in the right point.
Brilliant. Protection of IP. I think you touched upon it briefly there, but talk to us about that, how that works from a commercial, legal and tax perspective.
Sure. So once you've actually created that intellectual property, maybe the expenditure that you've had on that, you've been able to claim R&D tax credits, and maybe once it's in place and you've been able to speak to intellectual property laws and get that patented, then you can claim, patent box, get the tax relief on the profits that are derived from it, as well as the expenditure you incurred on actually creating it.
Yeah.
Then at that point, it may be worthwhile thinking, how valuable is this intellectual property? Because sometimes having the IP owned in the same entity, so within the same company as the trade, can cause certain risks. Yeah. What happens if the business, God forbid, does go under?
Yeah.
If that valuable IP, you created this great new technology, potentially you've lost that.
Yeah.
So at that point, you might want to think about what we refer to as company reconstructions, taking that IP and placing it in a different company, making sure that, if there are any problems with the trade, you're able to have that separate. Now, there are ways to do that very tax efficiently. There are plenty of reliefs available, but it's a complex area, and that's why it's always worthwhile seeking advice.
Brilliant. Very good. And then another thing that agencies are starting to explore as they get to this stage is working overseas. They might have one or two clients, and now they're starting to put staff overseas, and then maybe concerned or asking questions about what should I be thinking about as I start to move into a global business. What are those things? What should they be worried about or interested in from a tax perspective?
Absolutely. So when it comes to international expansion, that's an area that can be fraught with some complexity, but it also does bring a lot of tax saving opportunities in the right circumstances. So a common issue that arises when companies are trading in various different jurisdictions are issues to do with various different rates of VAT or sales tax that could be incurred. Now, one area that's a huge admin saving would be the called the one-stop shop for VAT, which is a scheme that can be entered into by companies to ensure that a single rate of VAT is charged across the EU. That can present tremendous admin and time-saving benefits. Worthwhile putting that in place, early, so that you're not getting bogged down in paperwork whenever you're trying to sort of trade abroad.
Yeah.
Now, at the same time, indirect tax is just one aspect of it. When a company gets to a certain size, if they are trading abroad, it can be worthwhile considering whether it's actually worth setting up a branch or a company that's actually a resident in another jurisdiction. Now, UK corporation tax rates are actually really quite low at 19%, going to be dropping to 17% in the future. But at the same time, if you're trading in Europe, there are other jurisdictions where if you are genuinely conducting economic activities in those other countries, it may be worthwhile setting up. As an example, places like, say, for example, Malta or Cyprus. Cyprus can have corporation tax rates as low as 5%. Malta also similarly low. It does require that you have genuine economic activities taking place over there. When the circumstances are right, that can present tremendous tax savings.
Excellent.
Well, just to add to that, we see lots of agencies with teams overseas, whether it's in locations where they've got people going into new markets, or often where they are using teams who are based abroad for development purposes. So it's quite a common area within the sort of agency world. And again, there's lots of tax issues. Clearly, I'm focusing on the R&D side, but one of the big things is taking advice early.
Absolutely right.
So if you're looking at contracts between companies, that can have a big impact on your R&D claim, your ability to claim. There's lots of other things where the earlier you can get that advice, don't set up and then say, can you have a look at this? Ask for that advice before you actually set up.
Yeah, great. Good advice. We talked about startup, talked about growth and I guess maturing. What about at the end when it comes to selling your business, either to an internal management team or to a trade or private buyer? What sort of things should you be thinking about there?
Absolutely. So when it comes to maybe not the end of the business life cycle, but sort of the point at which you're looking to maybe sell, as you mentioned, it could be management buyer, it could be an external seller. That's an area where there's a tremendous amount of various different tax reliefs that are available. All sorts of different ways to structure it and all sorts of different ways to save tax. The most commonly known is entrepreneurs relief. That can reduce the tax on disposal of the company to only 10%, which is tremendously low.
And that can make a big difference to how much you need to sell it for. If you're looking to achieve a net earnings of X, the amount that you need to now sell your business for is something less if you're only paying 10% tax.
Absolutely right. I think that it's actually really important what you've done there, Paul, which is to say, let's look at the practical implications of this tax saving, because it's all too easy just to get wrapped up in talking about, this low tax rate, great. But what does that mean for the client? What does that mean for you as the client? It can mean you can sell the business at a lower rate. It can mean that you have, more funds available to enjoy your retirement. It can mean all sorts of different things. These are real life things that make a real difference to people's goals and objectives. As well as entrepreneurs relief, there's also substantial shareholding exemption, which is a way you can reconstruct the business. And in the correct circumstances, you can sell shares for without any tax implications at all. You do have to have a corporate group structure. So there are sort of a number of other things to consider there, but that's another opportunity. And of course, if it's a management buyout, then that's where you can consider things like what we refer to as a company purchase of own shares. And that's where instead of expecting the management team to have the cash available, instead it's the company itself that can buy those shares from you. Tremendous tax saving in the right circumstances. And it's also, just a lot simpler to be able to plan that with the management team to whom you're passing on the business.
And that can happen quite often, can't it, with a successful business, because often owner manager will take out their basic rate dividends or maybe the higher to avoid the additional rate. And therefore they're building up this surplus in the business, which is about to be taxed at 32.5% or 35%, is it the additional rate? And instead they can potentially achieve 10% entrepreneurs relief tax
from the money that's actually in the business, through doing a company purchase of own shares.
Brilliant.
Well, just again to reiterate, with anything as you come to say selling a business, the key is to understand the tax implications early, not look at it just before you're about to sell the business and think
Absolutely.
about things like entrepreneurs relief planning or share options,
Yeah.
excuse me, or whatever it might be.
Yeah.
We see this a lot from an R&D perspective, where companies have been making R&D claims, and we'll explain, but generally they're making them under the SME scheme, which is applicable to companies with less than 500 employees. They then go on to be acquired by a large group. Suddenly the scheme under which they claim changes. It's important from a tax planning, a wealth management, a next step point of view to understand the implications early, because things like earnouts, as you progress to sell a business, can really be impacted by the R&D claim as you push on with that.
Yeah.
So again, take the advice early. If you're thinking about selling potentially in a few years' time, make sure that you understand the implications.
It goes back to what we were saying before about all business owners all get wrapped up in signing the next deal and boarding the next member of staff and doing the next marketing campaign, that all of this stuff can very easily get neglected, can't it?
Yeah, and it's not time consuming. That's the big thing. And certainly, technology makes it less time consuming.
Yeah.
But it's not spending hours and hours and days planning it out in detail. It's understanding.
That's what we do.
the key points.
Great. There's a couple of other things you've put forward to me here, Adam, which are really interesting. So in terms of, first of all, property, because I do think that's reasonably common in terms of the commercial property that you operate from.
Yeah.
If we can just touch upon that one first.
Yeah, absolutely. So one of the things that we sort of want to talk about is that, as well as the common things that are relevant for different businesses throughout their life cycle, there's also a number of weird and wonderful things that may just come up, and that's why it's always really important to get that sort of 360-degree review with your advisor. One of those areas that comes up, relatively commonly, but not all the time, is when it comes to purchasing a property. And this kind of reiterates why it's really important to plan in advance. So when you're coming to purchase the commercial property, there are all sorts of considerations from a tax perspective that many people don't necessarily take into account. So firstly, really key question is, do you purchase that commercial premises personally, or do you do it through the company, or even through a pension scheme? It's another common example. Purchasing it through personally can be advantageous, because if you, for example, want to charge rent on that commercial premises to the company, that's a way of extracting profits in a tax efficient way. Deductible for corporation tax purposes, no national insurance, kind of the best of both worlds. But there are pitfalls with that. You're charging rent, it can limit the ability to claim entrepreneurs relief. And if it's outside the company, perhaps way in the future when it comes to planning your estate for inheritance tax purposes, then business property relief, something that can commonly exempt all your business assets from IHT, is suddenly halved for personally owned business assets using the trade. So there are all sorts of implications there, and that's why it's really important to have that conversation early on. Now, as well as whether it's owned in a personal name or through the company, there are other implications that can often arise. For example, when it comes to purchasing a new commercial premises or one that's been opted to tax, then you can find yourself paying a VAT bill on a commercial premises. Now, people often think, well, the company's VAT registered, no big deal, it's fine, I'll reclaim it. But, cash flow is a problem. But also, something that may not be understood is that when it comes to calculating the STLT bill on the premises, we actually use the VAT inclusive price. So that can be a big problem. There are ways to plan around that, though. So if it's, for example, a premises that is say second-hand, and maybe there's someone already using that premises, and when you're going to buy it, you're thinking, right, we'll have vacant possession, then we'll move in. Well, actually, sometimes it can be better to keep that tenancy in place, because that can allow us to benefit from a tax-saving route called transfer of going concern. Sounds complex. All it is, as long as there was a tenant in there and the right conditions are met and all the boxes are ticked, it's outside the scope of that. That means no cash flow implications, but it also means a reduced SDLT bill as well. Now, as well as VAT, and you've also got capital allowances. When you're purchasing a property, people often think, well, capital allowances, I know I can't claim that on the building, so why should I consider it? Well, actually, within that building, there may well be fixtures and fittings that qualify for capital allowances. And only having that conversation early on is the only way that you can ensure that you claim all the relief that you're entitled to.
Mhm.
So even something as simple as buying a commercial premises can have so many implications. Not simple at all.
Yeah.
Not when it comes to the tax.
Great point. Just to add quickly, while there's no allowances on buildings, we look at it from a research and development point of view. And one of the reliefs that's now available is a research and development allowance on building costs.
Yeah, absolutely right. Yeah.
And so ordinarily companies will never see this as an opportunity because they know that while there may be features within the building that can qualify, there's no understanding that there might be opportunities available for the cost of the building itself where it's related to R&D activity.
And that's a really valuable additional relief that's only available when you claim it. R&D. So,
And this is why I think tax and commercial decisions are so closely linked, isn't it? Because like the pension one you talked about in particular, you being able to pay rent, so effectively your own pension pot, tax-free for the pension, can make a big difference between whether you lease your next building or whether you buy it, can't it? It can make a significant difference.
absolutely.
Great. Can we just finish off, Adam, by talking about some of the stuff available to the owner-managed businesses, owners themselves? So we talked about the business, but for them personally and their families, some of the things that they might be thinking about.
Absolutely right. So it's really important. I mean, I think it's really common for business owners to at least start to have those conversations about tax when it comes to the business. But it's really important to consider your personal position as well. And it's not just about saving tax for saving tax's sake. You know, any reduced tax burden can also free up more cash flow that you can reinvest into that business and growing that business. It can be more money that's available for your own retirement as well. You know, there are real life benefits to this that are well worth considering. Simple things like remuneration planning. So, okay, you might be a business owner, you might own the shares in company in your own name, but actually spreading that wealth, spreading those shares between family members can be a great way to help save, to help reduce the tax burden on money that's extracted from the business. Considering your personal investments, lots of changes to the taxation of landlords that very often need to be considered. Pensions planning, of course, hugely important area. And also, okay, you know, many people think that, you know, maybe they don't have to consider estate planning, but none of us are invincible. So it's always worth planning ahead for that sort of thing. And tax saved personally, as I say, is money that can be plowed back into the business to fund working capital, to take on better staff, and ultimately grow the business.
Yeah, making your business work hard for you rather than you constantly working harder for it.
Exactly.
Because it all goes to the bottom line. Yeah. Brilliant. Thank you.
Thank you, Bob.
Other Adam. So we're going to talk about R&D in particular now. This deserves a slot just in itself because it's just such a massive opportunity to get tax relief quickly. And what you find, I'm sure you found, we find, is that a lot of agencies come to you and they've never done a claim before. So we get a couple of years worth of claims through, and that can add some significant cash to the business, either instantly or via reductions in the future tax bills. There's going to be a mix of people on here today. Some people are already doing R&D, already see themselves as experts at it, enjoying get seeing the cash hit their bank every year. But there are others at the other end of the extreme where maybe they're new to R&D, they don't know what it is. So do you want to just start by explaining what it's all about?
Sure, yeah. So just to also not correct one point, but really emphasise that this is not just a tax relief, it's genuinely cash back for companies, whether you're paying tax or not. Really important thing for a lot of companies who are growing and spending. So really worth mentioning that. But R&D, you know, this is a government incentive for businesses. So this is not a grant for blue sky research. This is a government incentive intended to support the sorts of things that Adam's been talking about: attracting talent, retaining talent, innovating and growing the business. So R&D is all about science and technology, but mostly it's about, you know, technical jobs in the UK. It's about companies who are investing in people, investing in clever people, and investing to make themselves clever companies. And that's what the government incentive is intended to support.
Yeah, brilliant. And we talked about different groups of people who will be listening today. Just tell us what those groups of people are and what defines them.
Sure. We normally look at it as people falling into one of probably three categories to keep it quite simple. So there's those companies who have probably never claimed R&D before, which could be because they're not aware of it, or it could be because they're suffering from one of the common misconceptions, such as, I've got people abroad, can I claim on those costs? I've got clients paying me for this work, can I claim on the cost that I incur in delivering our services?
Or just I don't think it's innovative enough.
Yeah. I don't know if it's innovative enough. I don't know if I can claim. So there's that category of people where it may be that they don't have time, it may be they're not aware of it, maybe they've never heard of it, it's never been brought to them. That's probably the first category. The second is they're claiming, but probably claiming themselves. They've heard enough about it. They may have internal finance function, and so they're making a claim. Those companies tend to range from they're doing a pretty decent job to they really don't know exactly what they're doing, and therefore difficult to identify whether they've included the full scope of activities that can qualify, i.e. are they maximising their cash benefit? So there's that middle ground. The third group is probably companies who have some outside advice, maybe an R&D specialist providing that, or their accountant providing that, and they've been making a claim. They have some level of confidence that they're making a really good claim. So for those companies, the next step is always, how do you improve? And importantly, how do you start to use R&D strategically in the business to, in the same way as other tax issues, bring those real things to life? You know, how do you use it to influence commercial decisions? How do you use it to make a decision on whether to take on more staff, take on a riskier project, take on something that could make a name for you as a business? So there's always a next level. So that's the three categories we normally look at.
And that third category is about being proactive. It's rather than slapping yourself in the face at the end of the year and think, why did we do it that way?
Exactly.
Why, if we'd done it that way, then it would have led to far more tax relief.
Exactly. And we see this quite a lot, because those businesses who have made that shift in their thinking from this is an end of year tax exercise to, hang on, this incentive is available to help us grow the business, to support what we're doing. If you can shift that mentality and suddenly look ahead, armed with the knowledge of what R&D can do to influence the business, then suddenly you've got the opportunity to be much more strategic about it. And you know, that could be as simple as, we spend a lot of time working with companies on modelling projects that they're going to do, looking at what's the potential return on investment from an R&D point of view in this project. Have you just made the project 10% cheaper? Does that influence then how you pitch for that work? So all of those sorts of factors can suddenly have a big effect on your business. Again, we see it with taking on more people to accelerate projects. Can you hire another freelancer or another 2 freelancers to move things quicker, or to develop your system or product into something you really wanted it to be, but you felt you were cost constrained in terms of what you could achieve? If you have that knowledge of the impact that the R&D will provide, albeit at the end of your financial year, suddenly you have the ability to really move a bit more quickly, or move on a bigger scale.
Can we just go into that a little bit more then? So you talked about strategically planning your R&D. 2 questions, I think. What are some of the tips that you have in terms of things that you should be looking out for? And how do you proactively calculate it? Do they need to be ringing us or ringing you every time? Or are there calculators that we can provide them with? How do they make those decisions?
Sure, there's sort of some building blocks to doing this, which we like to help put in place to really support this strategic thinking. So those sorts of things are, have you got good record keeping in place? That's going to be different for everyone, but you know, if you can start to record people's time, start to understand what sorts of activities qualify as R&D, and start to make sure you've got almost real-time record keeping in place. This doesn't have to be onerous. We work with companies all the time to supply templates, to supply and help integrate processes into things that are already being done. That provides a really good foundation, because you understand the business, you understand the sorts of activities which are going to be cash generative from an R&D activity point of view. and you are recording that. So
Yeah.
you've got a good base there.
And it just helps with the stuff that we help with, the management reporting as well, because you can make better decisions on your business overall if you've got access to that data.
And quicker decisions.
Yeah. And it's become easier with the technology that's available.
Yeah, that's exactly right. So if you've got those building blocks in place, then you can look ahead and say, right, we understand from this type of project that we did that the return on the investment for the people involved in that was 25%. For example, we spent £100,000 on that project, we got 25,000 back. So if you can see that and you've got the ability to understand how that worked and how it can work for you, then you can look ahead and you can start to model future projects. So for example, we have tools that can help look ahead, understand what staff are going to be involved in a project. Are you going to be spending money on software within a project? And what might your return on that investment be? What type of activities can qualify?
Yeah.
And again, we can look back at projects that have been carried out. We can benchmark against similar projects. Again, in the market for digital creative agencies, there's lots and lots of examples we can provide to understand, well, is this project likely to have a small level of R&D? Is it going to be a much bigger level? What might the return on investment be? Then you can look ahead and say, well, where do I pitch my proposal for this work? Do I go in and say, I know my R&D benefit is going to provide a return on that investment. So how do I look at that?
That's one of the questions I've got, which I've put money on, someone's already asked it on the chat, will be how do they get access to some of those tools? Are they freely available?
Yeah, well, we work with companies as part of our service to help provide that.
Okay.
So we have built up some really strong methodologies and approaches to understanding R&D, and therefore towards putting together really robust R&D claims that HMRC understand, that HMRC can review and make sure that they're clear on how activities qualify. That's a really big area.
Yeah.
But the part that really feeds onto that is, as part of our service, wrapped up in the way that we charge for our work, is the next part of how do we work with businesses building longer term relationships to offer that strategic advice. Yeah.
Okay, brilliant. And one of the, I think it's good just to give people an example of something to help them to see this. One of the things we talked about earlier is like paying dividends. So this is a typical example of one-dimensional thinking when it comes to tax planning. So typically your accountant or Google will tell you that you should pay
a dividend,
minimum salary, and take the rest dividend, which makes sense because you pay less tax than if you took it all in salary. But from an R&D perspective, there's more that goes into the decision making there, isn't there?
There's a bit more thinking involved. So dividends as a cost category don't qualify for R&D purposes, which means that you're not recovering as a company any of the expenditure, therefore, for example, on some of your shareholders.
Yeah.
We see this quite a lot. It's raised all the time. If your director shareholders, you might have 4 director shareholders as an example, are taking a minimal salary and then taking dividends each year out of the company. But for example, they're providing a lot of the expertise in the business, especially perhaps around the more complicated projects, which may be the ones that have elements of R&D which are particularly high. Then there's a real decision to be made around whether you start to think about paying them a higher salary and potentially a lower dividend. Again, you can model that and you can start to see how it works.
It can change from period to period.
It can change from year to year, and you can start to figure out, is there a benefit to sort of having this discussion more regularly? Again, if you can see the data, if you can see the information, you're much better equipped to be able to make that decision.
Yeah, great. And can you talk us through an example? So again, people here will be early on the journey and it's a complex area. Help them to understand maybe an agency that you've worked with, what they did that qualified for R&D and what the outcome was for them.
Yeah, sure. Let's think about something which is maybe sort of less obvious. So we have a number of agencies who work in the sort of e-commerce type space. One of the reasons that things can be less obvious is that you're sometimes working with systems which can be reasonably well established. You're sometimes working with clients where the requirements at a high level don't perhaps seem overly complicated.
Yeah.
So what you really have to understand is the you have to understand the people in the business and the work that they're doing. So one of the clients that we worked with has developed some technology that helps to integrate the systems. And, this isn't something that they'll necessarily be selling on to lots and lots of different companies.
Mm-hmm.
This is bespoke work for a particular client, and it helps to integrate systems and provide real-time data and really generate a genuine advantage for the client that it's working for. Now, that sort of activity can be hard to spot. And so therefore you see companies not identifying that themselves, or perhaps advisors not going into enough detail to really pick those activities out. The flip side of that is you see things sometimes on a slightly larger scale where activity can be equally difficult to spot. Another of our clients provide services which are very much digital build, design, develop, build services.
Yeah.
And with this, we're talking about developing systems and platforms and websites to help run businesses and provide the systems that you see in the marketplace, but it's really the digital agencies which are putting those together.
Yeah.
Now, with this company, one of the ways that they provided people to projects, they were very uncertain about how the benefit would be captured. They didn't know what it would be worth to them. They didn't know if those activities could qualify. So it was really difficult to pick out and help them understand how that would fit together. Subsequently, they've made successful claims, also been through the process of an HMRC inquiry, which was successfully resolved. So really important for them to have that understanding before they go into the process, because a few claims along the line, they're sat with HMRC and they're able to explain clearly their understanding of R&D that has been developed.
And there's the proof that HMRC encouraged this. They've come out and investigated this and thought, we want to give them some tax back.
Yeah,
absolutely.
Yeah.
Could you just give us some numbers, like maybe a typical turnover size agency and what sort of value relief, just to give people a feel for the size of this? Yeah,
sure. And maybe we look at it a slightly different way. If you think about a company that has only 10 people, for example, and you've got 5 people who might be technical. Now, let's say that those 5 people are paid on average 40 grand a year. Okay, so you've got 200 grand there of cost that you can potentially look at. Okay, there's other costs involved, right? We'll just keep this example quite simple. So let's say that throughout the year, 50% of their time is qualifying. So you've got £100,000 in the pot for R&D. You can go back 2 years. So you've got £200,000 and the company can recover between a quarter and a third of that. So you're talking 50 to nearly £70,000 for a company that may not have made an R&D claim before, might only have 10 people, 5 involved in a reasonable technical capacity. They could be recovering between 50 to nearly £70,000. That's cash injection into the business that wasn't available. And you're not limited to then looking back and stopping. The R&D claim is something that you can make year on year.
Great. And again, comes back to that thing of making your business work harder for you. How hard is it to go and get £70,000 worth of additional profit?
Exactly right. Imagine trying to generate that sort of additional return on a project, or to go out and raise some additional funding from people. The time investment that you would find is very different. And streamlining the R&D process for people is something that we work hard on.
Okay, guys, it's been really good. Time has gone quickly. I'd like to spend a few minutes just taking questions from anyone that wants to pose some questions. But before we do that, any final pearls of wisdom, any bits of advice in terms of next steps with the things that you've discussed, so that people can go away with, I guess, an actionable step from today?
I think the thing that I've taken from sort of both of us is to always plan ahead and always speak to your advisors well in advance. Make sure you have that ongoing conversation.
Yeah, big thing for me is to avoid any common misconceptions and not to have any sort of lethargy around getting started or pushing further to make things strategically work for you. And so that's equally applicable from an R&D side of things as it is from a general tax planning side of things. You've mentioned it quite a few times, Paul, make it work for you. So get in touch early, have that discussion, have those conversations to really make it effective for you.
my bit, a lot of what we're doing is helping our clients to plan their finances. So what do you want personally? What does the business want? I think a lot of people kind of stop at the profit before tax bit. It's like, what's the profit before tax? But it should be the after tax bit that you focused on. Because often, as we've just said 1,000 times, that tax bit, there's a lot that can be done to affect that far easier than, getting rid of staff or holding back on marketing spend. You can actually make some of that savings from your tax as well.
Absolutely.
Yeah, brilliant. Beth, do we have any questions?
No questions.
No questions? Okay. Great. Thank you for everyone who's joined us today. We'll send out details for everything that we've discussed today, and my contact details will be on there as well. So if you do have any questions after the webinar, then feel free to reach out. I'd just like to say a huge thank you to you both for travelling your respective distances to be with us today.
Thanks, Paul.
And
Thank you.
thank you for your time. Cheers. Thank you.